William O'Neill is likely one of the greatest stock traders of our time. He is one of the market wizards that was interviewed by Jack Schwager. O'Neill made a large amount of money while he was only in his 20s, enough to buy a seat on the New York Stock Exchange. Today, he runs a successful investment advisory company to big money firms and is also the creator of the Ken Slim Growth Investment Strategy, which the American Association of Individual Investors named as the top performing investment strategy from 1998 to 2009. This non-profit organization tracked more than 50 different investing methods over a 20-year time period. Ken Slim showed a total gain of 2,763% over the last 20 years. This Ken Slim method is explained in O'Neill's book, How to Make Money in Stocks. O'Neill founded Investors Business Daily to compete directly with the Wall Street Journal, and he also discovered the cup with handle chart pattern. Those closest to O'Neill that have seen his private trading returns say that they are greater than Warren Buffett's or George Soros over the same time period. So in this video, I'm going to go through some of the trading principles covered in his book, How to Make Money in Stocks. Whether you are trading the Forex market or the stock market, some of the underlying principles are universal. So before I jump straight into the first principle, please do me a small favor and hit that like button. If you are new to this channel, do subscribe to the channel as well so that you won't miss out on any future videos that I upload. Number 1. He sells a stock he is holding after it has gone down 7% from his purchase price. I make it a rule to never lose more than 7% on any stock I buy. If a stock drops 7% below my purchase price, I will automatically sell it at the market. No second guessing, no hesitation, says William O'Neill. This is what professional traders do. They cut their losses fast and ride their winners. Whether it's the stock market or the Forex market, you have to be willing to admit that you are wrong and exit with a loss. Number 2. One of the major keys to his profitable trading was only having small losses when he was wrong. The whole secret to winning in the stock market is to lose the least amount possible when you're not right, says William O'Neill. This writes onto the first principle of riding your winners and cutting your losses. Notice that William O'Neill doesn't talk about having a high win rate. He talks about losing the least amount possible. A common misconception among new traders is that they need a high win rate of 80% in order to make money. Well, the truth is you don't, so long as your average risk to reward is lucrative. Perhaps something like 1:3 and you can be wrong 70% of the time and still make money. Number 3. William O'Neill studied historical chart patterns relentlessly and read thousands of trading books. 90% of the people in the stock market, professionals and amateurs alike, simply haven't done enough homework, says William O'Neill. Most traders out there simply learn a strategy on YouTube and start trading live money. They don't take the time to really understand the strategy thoroughly, nor take the time to backtest. And that's also why when they lose money after a couple of trades, they lack the confidence to carry on trading the strategy and trade through the drawdown. Number 4. He invested in an industry's leading stock and not its laggards or dogs. It seldom pays to invest in laggard stocks even if they look tantalizingly cheap. Look for and confine your purchases to market leaders, says William O'Neill. Applying this concept to the Forex market, you want to focus on pairing the strongest currency with the weakest currency. I've previously uploaded a video showing you how to select the right currency pair. If you have not watched that video, I recommend checking that video out next, and I will leave a link to that video at the top right corner and at the end of this video. Number 5. O'Neill's investing style leads to big winners and small losing trades. Investors cash in small, easy to take profits and hold their losses. This tactic is exactly the opposite of correct investment procedure. Investors will sell a stock with profit before they will sell one with a loss, says O'Neill. Remember that to be a profitable trader, you have to write your winners and cut your losses. Otherwise, you will never be able to pay for your losses. Number 6. He did not waste his time and money playing the short side in bull markets. Cardinal rule number 1 is to sell short only during what you believe is a developing bear market, not a bull market, says O'Neill. William O'Neill believes in following the trend. While he specializes in trading stocks, this same concept can be applied to the Forex market. Never attempt to trade counter-trend, especially if you are still a struggling trader. Go for the low-hanging fruits first. Don't be a hero because there's really no need to. Number 7. Fundamentals told O'Neill what to buy and the chart told him when to buy. The number 1 market leader is not the largest company or the one with the most recognized brand name. It's the one with the best quarterly and annual earnings growth, return on equity, profit margins, sales profit, and price action, says O'Neill. While this principle may seem hard to apply for the Forex market, it isn't if you understand how to read the Forex economic calendar. In our Forex course, we show you how to incorporate fundamental analysis with technical analysis. As William O'Neill accurately points out, the ideal scenario is where you can form your trading bias using fundamental analysis, then look to the charts to time your entry. If you wish to learn how we do this, access to our Forex course is free, and you just need to open an account with our sponsoring brokerage and fund in a minimum of $300. You can check out the link in the description below for more information on this. Number 8. O'Neill knew exactly what he was doing in the market. He had a trading plan, trading principles, and rules. Some investors have trouble making decisions to buy or sell. In other words, they vacillate and can't make up their minds. They are unsure because they really don't know what they are doing. They do not have a trading plan, a set of principles or rules to guide them, and therefore are uncertain of what they should be doing, says O'Neill. Having a trading plan is very important, and on this channel, we have repeatedly mentioned that you need to know what a good setup looks like. You need to have a step-by-step process that you will use whenever you are taking a trade. A checklist that will make sure that you are approaching the market in a consistent manner. You will never be consistent as a trader if your approach to trading isn't consistent. Pretty common sense, right? Number 9. He watched a stock's volume as part of his trading plan. The best way to measure a stock's supply and demand is by watching its daily trading volume. When a stock pulls back in price, you want to see volume dry up, indicating no significant selling pressure. When it rallies up in price, you want to see volume rise, which represents institutional buying. While volume isn't that significant in the Forex market, I have also uploaded multiple videos about how you can use volume to find key levels. Tools like the volume profile and the open interest heat map can be very useful if you know how to use it correctly. Again, these are videos that I've previously uploaded, and if you have no idea what I'm referring to, then that's another reason to hit the subscribe button and check out the other videos on this channel. So summing up, William O'Neill is a very successful investor and has provided quite a number of principles that have stood the test of time. In this video, I summarized the 9 principles which are pretty much universal. I showed you how the principles that apply in the stock market can also be applied in the Forex market. And that's it for this video. I hope you learned something valuable, and I'll catch you in the next one.